Alright, we're back. So here we are, we're talking about bull and bear flags. I just showed you a bunch of bear flags over here. So what I was doing, I was talking about this flag right here. So we had a break in the candle, we had a close, boom. So you could think that this is a bear flag. However, with all this consolidation right here, and it can't even get lower, it's a bad sign, and it broke below the trend line, so we wait for confirmation. We get a confirmation candle here. Now you could have went here if you wanted to and made a few pips, but I don't know. But I'm just showing you the flag. So this one closed above it, now we get it below. So that to me indicates trouble. It indicates possible sign of a reversal. Another one, and then boom. So here's the way that these flag patterns are supposed to work. And now you can see I have my little tools up here. Basically the way it works is, this is what you call the flagpole. Okay. This low to this high right here. That's what you call the flagpole. And I wish these lines were a little bit shorter so I could not make it so dang big. And then basically the flag also, need a couple more lines just so you can see. And then so you measure it here down, and then from this point down. Now this is a really small one. Normally you like them to be a little bit more of a consolidation, so you can kind of check it out. This one probably more of what they call a pennant. If you remember, I don't know if when you were a kid, if you had a pennant, it kind of had that triangle. This is a pennant. Same thing though. So what you do, basically what you're looking to do is the measured move of this flagpole is supposed to be at your target. So as you can see here, if we measure this move, we can see that it is 25 pips. So basically what you're doing is you're going for 25 pips. That's what your target is from this point, not from your entry, from this point. So wherever you get in, you have to minus those pips. So what I would do is you wait, okay, and then the theory goes that when a candle breaks this pattern right here, that's when you go. So if it would have broke to the downside, we would have known that it was not a bull flag. But obviously this one broke to the upside, and here's another mini bull flag, and another one, and another one. This one's a little bit hardcore. Okay. Now before we do that, again, like I said, I use these, how far are they? Here we go. I use these Fibonacci retracements to help identify. So swing high to swing low, you can see it nicely touched this 50% retracement, couldn't close. Hit it once, hit it twice, couldn't close below it. Again, that's when you start watching it, and then boom, we have it out here. So let's just say, hopefully I can clear this off of here. Let's see. Cool. Okay. So again, remember I said it was 25 pips. So we see the break of the trend line, and this is where our entry would. So what I would have been doing is I would have been minusing. Let's say, okay, 2 pips, not a big deal. I'm going to go ahead and just count the 25. My stop would be down here. Now what I do, again, I'm a scalper. Sometimes I don't look for those giant moves. I like to get in a couple different times. So what I would have done here is I would have measured down to here. I would have said, okay, that's 11. I always add 4 pips to my risk, because again, there's a 2 pip spread, and price tends to come back sometimes to where it was. And if it comes right back and you're only down 2 pips, if price comes and touches it, I get stopped out because of my spread. So I always add 2 more pips. So we said 11 plus 4 is 15. And what I do is I always go for 1.5 times my risk. That way I don't even have to be right 50% of the time. I don't even have to be right 40% of the time. And I'll still, if I'm right 4 times out of 10, I still make money. If I'm right 3 times out of 10, I'm pretty close, or I'm at break even. So you don't have to be right 50% of the time. But anyway, so, and I just, kind of round down. So half of 15 is 750. but I round it down to 7, so we'll say that's 15. I'm looking for 22 pips, and you can see that I would get, now, I would get all the way up here to 19. Now, I'm not stubborn. I usually will get out if my target is close, it gets to like three pips or less, I just close it, because I've seen it happen too many times, and you can see like right here, because even though you try to keep emotions out of your trade, it's very hard. So I would have gotten right here if I would have waited and said, oh man, look at that, it's coming up 18, 19, and technically I'd be getting close because of my stop, or my spread, but it would actually really only be 16, 16, 17. So I'd say, oh my gosh, okay, I'm a couple pips away, and then people, and even me, I would start to get nervous. This would happen, and then I'd see this, and then I'd be like, oh, okay, it's probably just another flag, and then boom, I would see all the way down to here, and look at that, I would actually be in the negative. All that positive, and I would be in the negative. And if that happened, and if I were to let it go, odds are, I may have just gotten out of this trade, even though I still have a 15 pip stop, and obviously we can see in hindsight it would have kept going, but emotions, which, I'm not going to say I'm perfect at, I've been really good at keeping them in check. Sometimes when you have that much, and you all of a sudden turn into a loss in less than a couple minutes, now you're freaking out, you're like, oh, I guess I was wrong, that's it. What I try to do is I try to let the market take me out. I have my stop, it's here for a reason, down here. This is where I think the trade is no longer valid. So that's where I'm looking to get in. I mean, all of our signals pointed to a higher move. Again, continuation pattern. So it gets up, and I probably would have gotten out right here. But then the same damn thing happened. Then I would have seen this. I would have seen this up move. And again, this is an uptrend. So I probably would have looked at it and said, okay, let's get our Fibonacci's out. Where did this move start? About right here at the swing low. And we measure it. So I would have saw those big candles, and I would have said, whoa, okay, wow, we're almost retracing to 100%. So I would not have gotten, that flag was just really far down. It almost retraced the entire thing. Again, when that happens, usually the odds are not good of it going back up. So I would have waited on that one, and then I would have watched and said, oh, okay, market's going higher. And then I would have gotten, here's another flag right here. And if we measure this one, we'll get our nice little low right here to up here. And now that one looks a lot better. Now we're down at the 61.8. We get a close, and then boom, we get a higher close. This flag is kind of big too, but it's not nearly as big as this one. So this one, I probably would have got in. Again, I would have. Now some people will wait again. Some people will do like this and wait till the flag is broken, or some people will actually wait until this high is broken, confirming a breakout. So that would be here. And again, the measured move. Now this was the end of the day on Friday, so not a lot of liquidity. Look at the volume; you can just see it all the way down. But if you're taking this trade, you get the measured move, which in this case is 24. We'll call it 26. But again, you're not getting in until this one. So you need to minus that, subtract it from it. And again, it's a measured move. So that would be 3, and we said what, 30? Dang it, I forgot already. My memory sucks. That would be 26. Okay, so 23. So you're trying to get 23 pips from here. Again, if you're doing it from the flagpole, that's what they say. Now, if you're getting in right here, I don't think that would have worked out for you. You only would have gotten up to the 11 mark. And again, for me, I would not have gotten out at 11. Now, if I would have taken this trade on a Friday and the market was closing in an hour, hour and a half, or an hour or so, or whatever, yeah, I probably would have just taken that and gotten out. Now, here's where the market, here's where the market closed. And we don't know. On Sunday, this thing could open up here, or it could open down here. I'm thinking it's going to open down just again because, if we borrow this trend line here, we'll just use that, we can see that a trend line has been broken. And I mean, look, so you draw it here, boom, it comes up, it touches, it goes up. I mean, look at this, just classic bull flags. If you would have drawn this trend line right when this happened, after this big move, look how many times it came down. One, it got close, damn near 2, 3, and here we go again, 4, 5, 6, 7, 8, 9, and it finally broke on the 10th time. 10 times it tested it. I mean, that's making money all the way up by these simple patterns. Now that's a nice move. Let's see, from the first time you would have gotten a good indication, might have been, again, first time, how many pip move to the swing low, all the way up here. Not bad at all. 50, 500, 34, no, 50, it's so late, my brain is fried, I'm sorry. It's just, I mean, it's a nice measured move, yeah. It's about, here's 45 right here, so yeah, it'd be about, that's a 70, call it a 70 pip move. I mean, if you're trading, one lot, you just made $70 in a couple hours, or you made, if you're trading standard lots, you could have made $700 in a couple hours. I mean, there's nothing that says, you have to, you trade whatever your risk is, but I mean, that's nothing, 70 pips in a couple hours, not bad at all. And again, it's not about the money, it's about if the strategy works. So you could have made money all the end of the day doing that, and then in the beginning of the day, if you trade those earlier sessions, I mean, you got it all the way down, and you got it, look at that, it just works. Go back to any more days, and you'll see that it happens over and over again. And here's a classic example of a bear flag right here. I mean, again, just classic. You got your giant move, which we call the flagpole, right here. That's a nice flagpole. And then we have, it's supposed to consolidate in a range. So move that all the way to back here. I'd like it to be at the end though, so there we go. Then we get another one. The flags are usually when they're more, when the lines are a little bit straighter, like this one. Yeah, there you go. So, and then again, I mean, look at that, classic example of a bear flag right there. I mean, that one screams, take me. Look at that. And again, it's in a range, can't break out of it, consolidating, slowly going up a little bit more, retracing. This one would have been hard to use on a Fibonacci, obviously, because it didn't really do much, but you'd have to get it from over there. It only retraced, I'm not even going to do it, but so look at that. And then again, it comes down. This happened at the start of the next day. This happened at what is that? At midnight Greenwich Mean Time, which my time is 5 o'clock at night. So I could have gotten in this trade right here. This is 5 o'clock at night my time, and that's when this right here is when Australia is the only market open, and then at 5 o'clock Tokyo and China open. So, which if you see on some of my other charts here, I have my stuff right here. So you got Tokyo, China. This tells me when the market's open. I don't have all these on this chart just because I wanted to keep it clean so you could actually see it. But yeah, so we got our classic bear flag over there. Look at that. 5 o'clock at night. I mean, and that's a huge violation of the trend line. Boom, breaks out. You get in, stop up here, go for the measured move if you want. Now let's see what this measured move was to see if it would have paid off.